The S&P 500, a simple way to invest. The S&P 500 is often touted as one of the simplest ways to invest in the stock market. But what exactly is it, and why is it so popular among investors? You hear it everywhere you turn. Financial advisors, news anchors, and even your friends might be talking about it. Invest in the S&P 500, they say. It's a common piece of advice, especially for those new to investing. It's the easiest way to grow your money. The idea is that by investing in the S&P 500, you're essentially betting on the overall growth of the US economy. But is it really that simple? Can you just put your money in and expect it to grow without any effort or understanding? The S&P 500 is a big deal in the financial world. It's one of the most well-known stock market indices and is often used as a benchmark for the overall market performance. It tracks the performance of 500 of the largest US companies. These companies span various industries, providing a broad representation of the market. Think Apple, Amazon, Google, the big players. These are companies that have a significant impact on the economy and, by extension, the S&P 500. When people talk about how the stock market is doing, they're often talking about the S&P 500. It's a quick way to gauge the health of the market. So should you throw all your money in and sit back? Is it really a set-it-and-forget-it type of investment? Hold your horses. Let's dig a little deeper. While the S&P 500 can be a great investment, it's important to understand what you're getting into. Investing, even in something like the S&P 500, is a big decision. It requires careful consideration and understanding of the market. You're putting your hard-earned money on the line. It's essential to know the risks and rewards associated with this type of investment. It's not as simple as throwing darts at a board. You need to have a strategy and a clear understanding of your financial goals. You need to understand what you're getting into. Educate yourself about the market, the companies in the S&P 500, and how they perform. We're going to break it down, plain and simple, so you can make a smart choice for your future. By the end of this, you'll have a clearer picture of whether the S&P 500 is the right investment for you. The power of diversification. Don't put all your eggs in one basket. Diversification is a fundamental principle in investing that helps manage risk and maximize potential returns. By spreading your investments across various assets, you reduce the impact of any single investment's poor performance on your overall portfolio. One of the biggest benefits of the S&P 500 is diversification. This index includes 500 of the largest companies in the United States, spanning multiple industries and sectors. When you invest in the S&P 500, you're essentially buying a small piece of each of these companies. Think of it this way. You wouldn't put all your eggs in one basket, right? If that basket were to fall, all your eggs would break. But if you spread your eggs across multiple baskets, the risk of losing them all at once is significantly reduced. Same goes for your money. The S&P 500 includes companies from all sorts of industries. This means that your investment is not tied to the fortunes of a single company or even a single industry. You've got technology, healthcare, energy, and more. Each of these sectors has its own unique characteristics and performance drivers. By investing in a broad range of sectors, you can take advantage of growth opportunities in different areas of the economy. This spread-out approach helps balance your risk. If one sector isn't doing so hot, another might be booming. For example, if the technology sector is experiencing a downturn, the healthcare sector might be thriving, helping to offset potential losses. It's like having a safety net for your investments. Diversification helps you sleep better at night. Knowing that your portfolio is spread across various sectors and companies can provide peace of mind, especially during volatile market conditions. You're not putting all your hopes on a single company or industry. Instead, you're investing in the overall strength of the US economy. This broad-based approach can help you capture the growth of the entire market, rather than relying on the success of individual stocks. That's a pretty good bet in the long run. Over time, the US economy has shown resilience and growth, making diversified investments a smart choice for long-term investors. By spreading your investments, you can benefit from the overall upward trend of the market while minimizing risks. The long-game historical returns and why they matter. When we talk about investing, it's essential to understand the historical context. The stock market has been around for centuries, and its performance over time can teach us valuable lessons. By looking at historical returns, we can gain insights into how the market behaves and what we might expect in the future. The S&P 500 has a pretty impressive track record. This index, which includes 500 of the largest companies in the United States, serves as a benchmark for the overall market. It's a reflection of the collective performance of these companies and, by extension, the economy. Over the long haul, it's delivered an average return of around 10% per year. That's right, 10%. This average return is a testament to the resilience and growth potential of the market. Even though there are fluctuations, the overall trend has been upward. Now, I'm not talking about getting rich quick schemes here. These schemes promise quick and easy money but often lead to disappointment and loss. True wealth building requires patience and a long-term strategy. Those are for the birds. Instead, focus on proven methods that have stood the test of time. Investing in the stock market with a long-term perspective can yield significant rewards. I'm talking about steady, consistent growth over time. Just like a tree that grows slowly but surely, your investments can flourish if you give them time. This approach minimizes risk and maximizes potential returns. The power of compound interest means those returns add up big time. Compound interest is like a snowball effect. The longer you invest, the more your money grows exponentially. This is why starting early and staying invested is crucial. But remember, past performance doesn't guarantee future results. While historical returns can provide a guideline, they are not a promise of future performance. Always be aware of the risks involved in investing. The stock market has its ups and downs just like life. There will be periods of volatility and uncertainty. It's important to stay calm and not make impulsive decisions based on short-term market movements. There will be years when the S&P 500 loses money. Market downturns are inevitable, but they are also temporary. Historically, the market has always recovered and continued to grow. But over the long haul, it's trended upwards. This upward trend is a reflection of economic growth and innovation. By staying invested, you can benefit from this long-term growth. That's why it's crucial to have a long-term perspective when it comes to investing. Whether you're saving for retirement, a child's education, or any other financial goal, a long-term strategy can help you achieve your objectives. Patience and discipline are key to successful investing. Keeping it simple, why index funds beat stock picking? Now you might be thinking, why not just pick individual stocks myself? Well, I'll tell you why. It's really hard. Even the pros struggle to consistently beat the market, and it takes a lot of time and research. Who has time for that? Index funds, on the other hand, are dead simple. They simply track a specific index, like the S&P 500. You buy a piece of the whole pie, no stock picking required. Index funds are also cheaper than actively managed funds. You're not paying some hotshot manager to pick stocks for you, and lower fees mean more money in your pocket. It's a no-brainer. Section 5, Tech Troubles, Understanding Sector Concentration Risks. Now let's talk about some potential downsides. One thing to keep in mind is sector concentration. The S&P 500 is heavily weighted towards technology stocks. Think Apple, Microsoft, Amazon, the whole gang. Now these are great companies, but if the tech sector takes a hit, the whole index feels it. It's like putting too many eggs in the same basket, even if it's a pretty good basket. It's important to be aware of this concentration. It doesn't mean you shouldn't invest in the S&P 500. It just means you need to be comfortable with the level of risk. Section 6, The World Beyond the U.S. Advice for International Investors. What if you're not in the U.S.? Can you still invest in the S&P 500? Absolutely. But there are a few things to consider. First up, currency exchange rates. The S&P 500 is priced in U.S. dollars. So, if your local currency weakens against the dollar, your returns could take a hit. It's just something to keep an eye on. Second, think about diversification. The S&P 500 is great, but it's only focused on U.S. companies. You might want to consider global index funds as well. These give you exposure to companies all over the world, spreading your risk even further. Section 7. Riding the roller coaster, navigating market ups and downs. Here's the truth, folks. The market goes up, the market goes down. It's a roller coaster ride, and if you're not careful, you'll get thrown for a loop. The key is to stay calm and avoid making emotional decisions. When the market takes a dive, it's tempting to sell everything and run for the hills. But that's the worst thing you can do. Remember, you only lose money if you sell at a loss. If you hold on tight and ride out the storm, history tells us the market will eventually recover. Patience is key, folks. Section 8, Dollar Cost Averaging, your secret weapon for steady growth. Here's a little secret weapon for you, dollar cost averaging. This fancy term simply means investing a fixed amount of money at regular intervals. For example, you could invest $500 in your S&P 500 index fund every month, rain or shine. This strategy takes the emotion out of investing. When the market is down, you buy more shares at a lower price. When the market is up, you buy fewer shares at a higher price. Over time, this balances out and can potentially lower your average cost per share. It's a win-win. Section 9, the bottom line, is the S&P 500 right for you? So, is investing in the S&P 500 really that simple? Well, it's simple to get started, that's for sure. But like any investment, it's important to understand the risks and benefits. The S&P 500 is a great option for long-term growth, especially if you're just starting out. It's diversified, easy to manage, and has a solid track record. But remember, it's not a magic bullet. There will be ups and downs along the way. Make sure you're comfortable with the risks, and diversify your investments beyond just the US. And most importantly, stay the course. Don't let emotions get the best of you.